In today's video, we're going to be taking a look at Salesforce. If you're new to the channel, my name is Sean. I do investment research, so you don't have to. And the goal for our channel here is to beat the S&P 500 and share some of those insights with you. So if you're not already, make sure to subscribe to the channel. Looking at Salesforce, it just recently sold off about 27, almost 30% off all-time highs. And it's got a market cap of 219 billion, enterprise value of 204. And a price to earnings of 40.69, which will become important later in the video. If you don't know what Salesforce is, pause the video and read this description. Looking at the financial strength, they have a cash debt ratio of 1.41, so for every dollar of debt, they have $1.41 to pay down the debts or expand the business. Moving to the profitability, we can see that their margins for the business are some of the best in the industry, and versus history, these are pretty solid numbers they've achieved for just about every stat. This is a software company, so pretty high gross margins, operating margins. They net 15.3% of their revenues and also have pretty high cash flow with 31.71 free cash flow margin. So the business does look profitable. I use ROE, ROA, ROIC, and ROC for management strength. And for these, it's okay. Not too impressive. But that price to earnings ratio, we can see that their current of 40.69 is just above that minimum for the last 10 years. In the last 10 years, they've traded at a median of 144 times their earnings. So even though 40 times is not by any means a cheap valuation, this is just about the lowest they've had in the last 10 years. We can see that their annual revenues are up and to the right. On a trailing 12-month basis, we can see that the net income did slow down for a while and then picked back up. Their cash is currently outpacing their debts. We had some share buybacks in 2023 and early 2024, and now a slight share sale most recently. The reason that we saw this roughly 20 to 30% drop here is because of lowered expectations for guidance in the future. When a company lowers its guidance, it can have a negative impact on the stock. And the only question is if the impact was justified or not. So we're going to check out the DCF just to see how the valuation looks and what's currently priced in. So for earnings per share, looking at earnings per share without NRI, over the last 3 years, they have a trend line of 414%, so serious growth for earnings per share, at least in the last 3 years. I don't believe they can achieve 400% over the next 10, but pricing in 20, I think, could be reasonable, which would leave us with a margin of safety of 19%. And there's currently about 17% priced into the business for earnings per share over the next 10 years. Looking at free cash flow, we can see that in the last 10, they've achieved 23. The last 5, they've averaged 19. And the last 3, 29. So I think 20 could be reasonable. And there's currently about 13% priced in for the next 10 years. So both on a free cash flow basis and earnings per share, it does look to be fairly valued or even slightly cheap at this position. When it comes to them lowering their guidance for the full year, I see this more as a short-term hiccup than a long-term problem. But having a valuation of, call it 220 billion, I would be asking myself if I were to be buying this stock. I see a lot of opportunities out there that I think are in better positions than this, but I would be asking myself, do I think this $220 billion company can become a $440 billion company? I would say yes, it could, because it's very dominant in its industry, and I would say it's one of the leading softwares. They have high margins, the management's doing okay, they have a good cash debt balance, and the valuation is fairly cheap. So this wouldn't be a terrible place to be buying more shares, especially if you were already a shareholder. But because I've seen better opportunities elsewhere, those are going to be my first picks. But Salesforce, all in all, it is roughly the cheapest you're paying for what they earned in the last 10 years. So that's a pretty good signal. If I already own this company, I would definitely be buying more at this point. or even giving it a week just in case it continues down another 5% or so. But I would expect this over the long run to recover and regain this relative slope.